Okay, I think it's time for us to get started. Good evening, everyone. My name is Perry Lazarus, and I'm a financial advisor here at Financial Advantage Associates. First, I'd like to start by thanking everyone for joining us tonight. We really appreciate you taking the time out of your day. Here at Financial Advantage, we try and give a ton of educational seminars on a wide variety of topics. In the past, we talked about things like Medicare and the 2024 election and Social Security, and we're hoping to continue these into the future. So if you have a topic that you want us to address, just reach out to the person that invited you, and hopefully we'll be able to add that to our group. Before we get started, I want to thank a couple people for helping us make this night possible. So I want to thank Allison McCarty, Drew Brand, Grant Lagasse, Jason Silverberg, John Graciani, Nick Carter, John Abbott, Lindsay Carter, Wade Friedel, Wes Battle, and myself for helping us fill this digital room. So today we're going to have Mike Sinoski, who is the director of Transamerica's Advanced Marketing Group, talk to us about the impact of the Big Beautiful Bill. Um, if you have a question for Mike, please just put in the chat. Um, you guys are all muted right now. Don't unmute yourself, mainly because otherwise we're going to have 200 different people's background noise going on. So just put in the chat, and we'll either try and answer it in the chat during the presentation, or we'll address it afterwards. To be honest, I assume we're going to get a ton of questions. So if we don't answer your questions, please don't be offended. Just reach out to the person that invited you, and they will definitely be able to answer it for you. However, before I turn things over to Mike, I'd like to introduce Lindsay Carter. She runs Financial Advantage. She runs the operations here at Financial Advantage. She's also the director of FAA Tax, who's our affiliated accounting firm. And she's one of my good friends. And she's going to go over some year-end tax planning strategies to consider as we head into the final months of the year. So with that, Lindsay, I'm going to let you take over.
Thank you, Perry. And thank you all so much for taking the time this evening to join us. As Perry mentioned, I have the privilege of spearheading FAA Tax. Our team exists to complement the terrific advisors at Financial Advantage and their holistic wealth management initiatives. I want to thank my colleagues, Jeff Bond, Juan Paredes, Pete Corner, for joining us this evening. This is our favorite time of year. For those of you who may not remember, back in 2017, during President Trump's previous term, Tax Cuts and Jobs Act was passed by the Senate December 2nd of 2017. And the House and Senate finalized that bill December 20th. So if you can only imagine, it was a very rushed planning season during that first term. And so I feel pretty fortunate this round that we have a longer timeline to review changes, talk about the year ahead, and leave everyone a little bit of latitude so that they can execute some decisions to be as efficient as possible. I'm very excited for Mike's presentation this evening. He has some great material to review with you. But before I turn the mic over to him, I just want to share a few year-end action items that I encourage you to review with your advisor. If myself and the tax team can be a resource to you, we would love to have the opportunity to collaborate with you in the upcoming short months ahead. So with that, I'm actually going to share my screen and be proud of myself for my technical abilities here. Hopefully you are able, and we're looking at the year-end review. So a couple of items that we can execute before December 31st in order to impact your 2025 tax liability. These are all tax savings moves that you can make before year end. So I encourage you to meet with your advisor, meet with your team, and review and see what you can put into place. Review contributions to your workplace retirement plan. Not only can topping out contributions reduce your tax liability or tax income for the current year and boost your overall savings, but doing so can be a great planning strategy if you think your tax rate will be lower in retirement than it is today. On the other hand, if you believe your tax rate might be higher next year or during retirement, look at funding a Roth account and make sure you're topping out that maximized contribution. For those over the milestone of 50, remember you can utilize the catch-up ability that might be available to you. And those in that sweet spot of ages 60 to 63, remember that for this year and next, you have a supersized catch-up available to you. So I just want to make that reminder. Review your benefit enrollments for 2026. This time of year is often the time where you complete your open enrollment, review your eligibility for things like a health savings account. We love HSAs for tax planning. And for those of you with children under the age of 13, review dependent care flex spending account options. Those have increased for tax year 2026 up to $7,500, which is a $2,500 increase from previous years. 529 contribution. This is a good one. Most states require accounts to be opened and funded before the end of the year in order for those contributions to be deducted on your 2025 tax return. I want to make a really strong emphasis that grandparents, you should review these opportunities as well. Often you can contribute and enjoy the tax benefits at the state level. I would absolutely discuss this with your advisor. Review your QCD, qualified charitable donation opportunities. Review those with your advisor. You do have to be at a certain age, but our affiliated team at Financial Advantage can absolutely help guide you through this. Review your gifting strategies. The 2025 tax laws expand the ability for individuals to deduct charitable contributions above and beyond the standard deduction, and look at larger gifting opportunities and discuss those with your advisor. Donor advised funds are a great strategy. The annual gift tax exclusion for 2025 is $19,000. Feel free to reach out to our team and we can talk about what that means. The Big Beautiful Bill Act temporarily increases the SALT cap, which a lot of us are familiar with. So our state and local tax deduction, it's up to $40,000 for many individuals for tax years 2025 through 2029. This potential opportunity could save you money, but make sure you review your individual circumstance. As a reminder, something for you to look at, if you happen to make estimated tax payments, I'd consider perhaps making those for the state in December in lieu of waiting until January 15th. It's a way to possibly bunch your deductions and utilize our larger SALT cap deduction. Take a look at tax loss harvesting strategies. This is a great time to meet with your advisor. Look over your portfolio. Look at any opportunities to help offset some realized gains that may have come in during the year. For those of us that may be joining who are business owners, I'm going to switch slides here. I would take a look for those before year end, look to maximize your retirement contributions as either a self-employed individual or a business owner with employees under you. Business owners can significantly lower their taxable income while saving for their own retirement by contributing to employer-sponsored plans. Contact your advisor to review what type of plan you have and what dates and amounts you're eligible for contributions towards. We want to take a look at maximizing depreciation deductions. This is a big one under our new tax laws. Utilizing Section 179 expense and our newly updated under the One Big Beautiful Bill is the ability for business owners to take advantage of 100% bonus depreciation. This is a major reversal from the prior phase down schedule that we had. It was set to expire. However, pending your situation, this is something that you should look at, as the new law does allow you to choose between taking a larger upfront deduction for certain qualifying equipment, or you can also choose to take a traditional route and take a lower deduction. Look at optimizing your income and expense timing. Controlling the timing of revenue and deductible expenses is a huge fundamental year-end strategy. Deferring income, accelerating expenses. If you're someone who expects lower income from one year to the next, you may want to consider delaying invoicing or collecting payments in January. At the same time, you might want to prepay qualified expenses in this year. And last but certainly not least, I would say, is consider claiming available tax credits. Mike's going to go through some of these today, but review which federal and state tax credits could be applicable to you. Our new tax bill expands research and development credits. Look to see if you make the criteria to utilize work opportunity tax credits or small business healthcare tax credits. And as I kind of alluded to, but I will close with, reach out to your advisor and feel free to include our team to conduct an individualized review so that we can best assist you and plan as we close out and head into 2026. I can't believe I'm saying that, and it's already the end of October. With that, what I'm excited to shift the conversation to Mike Sosnowski. Mike brings more than 20 years of experience. And Mike, I'm going to go ahead. You can transfer while I continue to introduce you. But Mike brings more than 20 years experience in the financial services industry. He specializes on advanced planning, and he's a great partner of ours here at the firm. He put together some terrific content on our 2025 Big Beautiful Bill Act. As a reminder, just housekeeping, send all questions to the chat. We're going to review those throughout the presentation. We'll share what we're able to at the end, but if we're unable to get to your question, or if it's something that's individual to your circumstance, still feel free to send it, and we're going to circulate answers from either the individual who invited you, or you'll hear from our team directly. And with that, Mike, I'm going to welcome you to take the virtual stage and kick us off.
All right, sounds great. Thank you, Lindsay. And you can see the title slide for the presentation. Looks good.
You look awesome, and we see that presentation.
All right, fantastic. Well, I appreciate that. So thank you. I thank everyone for joining us tonight. As Lindsay had mentioned, I'm with the advanced planning team at Transamerica. And just a quick background on who I am. Basically, my responsibility is really to provide information on different financial planning topics. And with that, I would say a common topic included in most, if not all, conversations is taxes. So that's what we're going to talk about today. We're going to talk about taxes, really more specifically, as Lindsay had mentioned, the 2025 Budget Reconciliation Act, otherwise known as that one big, beautiful bill. So this thing was signed July 4th, 2025, and it's described really as the largest tax cut in history. And what it did is it made made permanent some of those tax cut provisions from our previous act, which was that Tax Cuts and Jobs Act. So that was back from 2017, as Lindsay had mentioned. So this new bill, what it did is it introduced new provisions really for individuals, for businesses, for estates. And what we're going to do today is we're going to look at some of those different provisions. But before we do, here's just a little word from compliance. So this is compliance here. And then, of course, you can never have too much compliance. So here's a little bit more compliance. All right, so this is really what we're going to look at today. First, we're going to look at the current fiscal environment. We'll touch on a couple of those OBBA provisions, and then we'll wrap up with just a couple of planning ideas, really planning ideas that could work in any type of tax environment we may encounter. So I think a really good place to start this presentation is really right here. This is where we stand. Our current level of national debt is $37 trillion. That number right there, that puts us in first place. The U.S. currently holds the largest national debt in the world. And believe it or not, we're not done. We add about 2.3 trillion to that number each and every year. So that really brings up the question, why is our debt so high? Well, really what it comes down to is basic accounting. It's pretty simple. As a country, we spend more than we collect in revenue. And when it comes to spending, we spend a lot on Social Security and healthcare costs. Then, as our debt continues to grow, we spend more and more on interest payments. And these interest payments that we're in debt to, these were from a rising interest rate environment, which just increased the cost of borrowing at the time. So long story short, our interest expense is actually outpacing all these other spending categories. And if you look at that blue box there, we owe about $1 trillion a year just in interest payments alone. So that's where we stand. So the follow-up to that is really, how do we fund this debt, right? How do we eventually pay it back? Well, you guessed it, with taxes. And there's really three notable taxes out there. We have federal income tax, we have capital gains tax, and we have those estate taxes. And what we're showing here on this slide is it's really the top tax rates for those three going back to 1913. And the reason we went back to 1913 is because that's when those income tax brackets were first introduced. So if we look at this chart here, if we look at that green line, basically, if we focus on the early 40s, to the early 60s, what this is showing us is that high earners in this country were faced with a tax rate of about 90%. So really with this chart, what this is designed to do is take a look at the historical tax rates, just in that historical context, because what this does is it kind of makes us question, right? It makes us question whether or not today's tax rates are currently too high, as we've heard arguments for, or if they're currently too low. So could this mean that maybe if we look at this historical context, that taxes could be higher in the future? Well, the answer to that is really, who knows, right? It's anybody's guess. But what we do know is that our spending continues to exceed our revenue, and that's just adding to our debt. And when we look at those social entitlement programs like Social Security, when we look at Medicare, well, those programs are expensive, and they just continue to add to spending every year, which adds to our national debt every single year. And if we look at those tax rates from the previous slide, those tax rates are, in comparison, at historically low levels. So that's kind of where we stand, which brings us now to the one big beautiful bill. So just like a sunset, tax laws come, tax laws go, and the Tax Cuts and Jobs Act that we had from 2017, that almost faded away over the horizon. It was set to sunset at the end of this year. And what they say is that if that had happened, the result would have been tax increases of over $3 trillion. And the belief out there is that it would have put us in a recession. Not sure if it's a mild recession, but either way, we would have been in a recession. So all of that was avoided. And it was avoided thanks to really the passage of that massive tax package called the One Big Beautiful Bill Act. So with that, some wanted greater tax cuts, others wanted greater spending cuts. Let's see what we got. All right, what we have first is a decrease in spending for the next 10 years, a decrease of about 1.1 trillion, which is good, right? We're reducing our spending. That's fantastic. But, and there's always a but, right? We also have a decrease in revenue with 4.5 trillion in tax cuts over the next 10 years. So what we're going to do is look at some of the highlights. With this bill, not only did this piece of legislation extend some of those major provisions of the Tax Cut and Jobs Act, but it added a few new items that we could talk about. And many of these items you probably heard about, right? You've seen pop up as headlines on different media outlets. Our goal for today is really to provide an overview and just an understanding of how some of those provisions could impact you for maybe this tax year, next tax year, and really going forward. So what we have on this slide is it's really an overview of the tax reform itself. And what you may have noticed here is it's a lot of small print. But basically what we have is a table that looks at what would have happened, what's happening right in the middle, and what's going to happen, what will happen. So that first column, that red column there, what that shows us is really what we were facing with a potential sunset of that Tax Cuts and Jobs Act. So you can see there, a lot of red text. The next column is really the landscape in 2025 before the passage of the OBBA. And that's a nice, comfortable shade of, looks like a baby blue. Last column, changes thanks to the One Big Beautiful Bill Act. And here we have the green, right? The comforting green. And basically the color text of the slide represents a tax scale. The red areas are really those thresholds that would have resulted in higher taxes for individuals. The green is really items that moved in favor of taxpayers. And then that blue is really neutral, right? It's the blue that's that frame of reference as to where we were before the OBBA and before some of the provisions of that act actually kick in. So let's look at those provisions in a little bit more detail with here. We're going to start with deductions, because this bill, one of the significant areas of change for taxpayers is with deductions, whether it's a deduction change or a deduction addition. We'll start right here. Miscellaneous itemized deductions. OBBA eliminated most of those miscellaneous itemized deductions. It's really those miscellaneous itemized deductions that were subject to the 2% floor. So those were eliminated, like investment expenses, tax prep fees, those are gone. And it introduced basically a limit on itemized deductions for those in the 37% tax bracket. And to make things even more confusing, not all these provisions are going to become effective this year. And that's why we have this timeline. So some actually kick in 2026. And that's what we have in this timeline. As you can see, some of those provisions are 2025. Others start in 2026. And then here, some of them will end in 2029. Or as we like to say, sunset in 2029. So let's take a minute to look at that standard deduction. OBBA increased the standard deduction. If the Tax Cuts and Jobs Act had sunset, then the standard deduction would have been basically cut in half. It would have been down to about $7,800 for single filers, about $16,000 for those filing a joint return. And instead, not only did this act increase the standard deduction all the way up to $15,750 for a single filer, $31,500 for those filing a joint return. On the bottom here, it also added a $6,000 deduction for those age 65 and older, which is really on top of what they already have, which is the additional $1,600 or $2,000 deduction they receive. So what we're going to do is look at that deduction in a little bit more detail. And so this is for those 65 and older. And the deduction here, it really started as a campaign promise. It was a promise to eliminate Social Security taxes on those Social Security payments beneficiaries receive. Well, when it was all said and done, the final bill, it fell short of delivering on that promise. So instead, they went with, I guess you could call it Plan B. And that Plan B is this temporary $6,000 tax deduction for individuals 65 and older. And what's nice is that it's a deduction that doesn't require a taxpayer to itemize. So there's no itemization. You don't have to worry about that, but the deduction does have a phase out. And if you look at these phase out levels, kind of in the gray area, individuals can claim the $6,000 deduction if their income is $75,000 or less, or married couples up to $12,000 if income is $150,000 or less. And then after that, that deduction just starts to phase out. Phase outs over that threshold amount until it's completely phased out. So with that, the act itself, it didn't eliminate taxes on Social Security benefits entirely, but what it does is it significantly reduces the number of seniors who are going to pay those Social Security taxes on their payments. There's some research out there. There's a study by the Council of Economic Advisors, and what they say is that they project that 88% of Social Security beneficiaries will no longer have taxes on these payments. So the deduction itself could be a nice relief for some individuals collecting Social Security, because as of right now, about half of all beneficiaries will pay taxes on those monthly checks. And I guess what's kind of nice is that with this deduction, it can help reduce an income tax liability really for anyone 65 and older. It's even true if they're not yet collecting Social Security. So you don't have to collect Social Security to be eligible for this deduction. So that's kind of nice. But we do have the phase outs. So that's something to be aware of. And then we have, as Lindsay kind of mentioned earlier, a change in this itemized deduction. So the OBBA Act, what it did is it temporarily increases the SALT deduction, right? That deduction for state and local taxes. And it's going from $10,000 mark up to $40,000. And this is, I think I jumped the gun here. And this is let me go back here. There it is. Basically, what this is going to do is increase every year. So this 40,000 increase every year all the way up until 2030. And then in 2030, that's when the SALT deduction is going to go back down. It's going to go back down to 10,000. So what we'll probably see is maybe another, I don't know, congressional battle over the future of SALT. But what you really have to keep in mind is that this $40,000 deduction is really available for taxpayers that are earning less than 500,000, because then it starts to phase out, and it phases out to where it could eventually go back down to that $10,000 mark. So either way, it's a provision that can maybe benefit those filers that are in high tax states where they can take advantage of SALT, maybe take advantage of a something like a mortgage interest deduction. Basically, any deductions that they can come across to have their itemized deductions exceed that standard deduction. So that's the big thing with the SALT. You do have to itemize your deductions in order to take advantage of any type of tax savings. But this could be a deduction that could be incredibly valuable to some. And I think that's why it's really important just really to meet with your advisor on the FAA team just to see if itemizing makes sense and if you may be able to capture this deduction while it lasts. So we have SALT. Another campaign promise is this one right here. And this one, this one might be more significant maybe for kids, maybe for grandkids. But just like Social Security, tips are still taxed, but there's now a deduction, right? The campaign trail had no taxes on tips. Well, really from now until 2028, up to $25,000 of qualified tip income can be deductible. And that's true for each filer. So really, it's a nice relief for certain individuals, maybe those individuals that are in the service industry. But like those other deductions, it does have a phase out, and it phases out with incomes of north of $150,000 for single filers and $300,000 for those with a joint return. And with this deduction, basically the IRS is working on providing a list of occupations, because for any individual to qualify, the tips need to be customary and regular. So that's kind of the big requirement for that tip deduction. But again, could be something that's maybe more valuable to maybe kids or grandkids, maybe college age individuals, those individuals with first jobs, but really anybody receiving tips. And then some kind of similar to the tip deduction is this overtime deduction. Doesn't require anybody to itemize, which is nice. And this one's $12,500, a $12,500 deduction, or $25,000 for joint filers. But it's for any pay that an individual receives that exceeds their regular rate of pay. That's the overtime. So it's a deduction that, again, could maybe help out certain individuals. Does have phase outs. The phase outs, $150,000 for single, $300,000 for the joint. So it's a deduction, available itemizers, those that don't itemize. And again, it could be something that's nice for maybe those family members that get paid more than their regular rate of pay. And then other deduction here, this one we'll just talk about quickly, but it's the new U.S. assembled auto loan interest deduction. And basically what this is, it's a deduction of up to $10,000 of auto loan interest on loans to purchase a new U.S. assembled automobile. Where the automobile could be a car, could be SUV, could be motorcycle. But really here, if you're thinking about buying a U.S. assembled car and taking out a loan for that car, definitely talk to your advisor at FAA just to see if you qualify for this deduction and maybe able to take advantage of that $10,000. But there are phase outs and a lot of other requirements like this slide here. We won't go over those details. Instead, what we'll look at is the charitable deduction. So as I mentioned, as we all know, Tax Cuts and Jobs Act increased that standard deduction that we have available. The OBBA increased it even further. And really, the result of that large standard deduction was that many taxpayers made these charitable contributions, right, these charitable gifts, and they weren't able to deduct because they didn't have enough deductions to itemize. So they took the standard deduction. Well, the OBBA, what it did is it introduced this permanent deduction for charitable cash contributions up to $1,000. So $1,000 for single filers, $2,000 for those filing a joint return. And again, it's regardless of whether you itemize or you take the standard deduction. So that's kind of nice, $1,000, $2,000 joint filers. But as a trade-off on the bottom here, there's now a limitation on charitable deductions for those that do itemize. And the itemized charitable deduction is now limited to the amount these deductions will exceed somebody's adjusted gross income by 0.5%. So that was a mouthful. Definitely something you may want to discuss with your advisor on the FAA team. And really, the last provision of the OBBA that we'll mention today is a couple of these. So we have that child tax credit. It went up slightly to $2,200, index for inflation. AMT exemption, the phase out's been reduced, so that may impact some individuals. 529 plan distributions, there are now new expenses, like one of which is K through 12 education costs, all the way up to $20,000. So that could be another reason to look at 529s. And then we have the bill extending the qualified opportunity zones for investment purposes, is really what that one is. And then we have the repeal of those clean energy tax credits from previous administration. So those are really the main provisions that will impact individuals, as they file their tax returns. But it's really this last provision of the OBBA that I want to talk about. And this is the estate tax exemption, which is really the amount that can be passed at somebody's death free of estate taxes. And what you can see here on this chart is that it's really been changing, right? Changing consistently over really the past 2 decades. So long story short, the Tax Cuts and Jobs Act, if that had sunset, like we talked about, the exemption levels would have gone back to the 2017 levels, where we would have had about a $6 million exemption, meaning that estates over $6 million could be subject to an estate tax liability. But instead, what we have is a $15 million exemption. And that's an exemption in 2026. Going forward, it's not permanent, but we know that we're going to have it at least for another 4 years. So 15 million index for inflation going forward. So that was a lot of information, especially at 6:30 at night on taxes, right? Just to kind of sum things up here, what we have here is the thermometer of the it's really the tax landscape, and it's really after the passage of that OBBA, and it's really just showing that tax brackets are remaining the same, but now we have some colorful phase outs that we've added because of the act. But tax brackets remaining the same because of the extension of that Tax Cuts and Jobs Act. So what I want to talk about now, just to kind of wrap things up, is a couple of planning strategies. And what these strategies really focus on are tax diversification ideas. Because really, no matter what happens each and every year or every 4 years with different tax changes or different rules being implemented, it's really a diversified strategy that can help really hedge against uncertainty. And basically, what this is more of a focus on asset location instead of asset allocation. And I'm going to quickly go over these ideas, but again, these are great ideas, especially with the end of the year coming. Great ideas to go over with your advisor, where they could go over more detailed, especially when it comes down to your specific situation, because every situation is different. All circumstances are unique, and these strategies could be advantageous to some. So what I want to start with here is just, this tax diversification. It could be beneficial when we look at individual planning strategies. It can be beneficial when we look at wealth transfer strategies, wealth planning strategies. And again, it's really that tax diversification that can hedge against the unknown, because who knows what tomorrow is going to bring, right? So when it comes to really individual planning strategies, a good place to start is right here. And this is really looking at the different types of accounts that we have. And there's three broad types of accounts: currently taxable, tax deferred, and on the right over there, tax free, where the goal is to diversify assets across those different account types with the different tax characteristics. So what we could do first is really just take an inventory, right? Take an inventory and just see what assets and what investments we have in those different accounts. What do we have in taxable accounts? Are those, most of our stock positions, mutual fund positions? What investments are in those tax deferred accounts, like our retirement plans or IRAs or annuities? Those, when we look at them, they're going to have tax deferred status, but when we look at taking distributions down the road, that's where it's taxed as income, or your income tax rates. And what we have on the right here is those accounts that can generate tax-free income. Tax-free income like a muni bond portfolio or Roth IRA withdrawals. And it's really taking this inventory, it helps us see where these assets and investments are housed, right? And what accounts are these investments in? Do we have assets spread out across all three, or is everything concentrated maybe in just one type of account? Quite often what we'll see is individuals will have most investments in their tax deferred accounts because that's their retirement plan. So what this does is just allows us to be able to see if we're matching up the right investments with those right accounts being the tax status. And it's really a simple idea like this that, can help create that hedge against what could be a potentially higher tax rate in the future, especially whenever we may be facing another tax policy change. So that one tax-free account that I mentioned that was on the right, that was the Roth IRA. I know Lindsay kind of mentioned the Roth earlier, but it's really that account that could truly hedge against what could be potentially higher tax rates in the future. And what's really nice about the Roth IRA is that it has a lot of different benefits. And what I mean by that is that Roth IRAs will go tax deferred. When somebody's ready to start taking withdrawals, they're tax-free withdrawals. When we're accumulating in that account, there's no required minimum distribution rules. So there's no required minimum distribution that has to come out each year like a traditional IRA. These accounts are also great for estate planning because inheritances from these accounts will pass tax-free to the beneficiaries. If we're thinking about tax-free withdrawals, tax-free distributions, what's nice is that those withdrawals won't increase our Medicare premiums in retirement, right? They're not going to increase what could be a premium that's subject to IRMA, right? Those adjustments for income. It's not going to increase any type of taxation of Social Security. And really, if you look at a Roth IRA, they're great accounts for those one-off big ticket purchases. Maybe like that vacation home in retirement, or just a vacation in general, or maybe that new car or boat. But again, it's a tax-free distribution that won't impact all these other potential expenses along the way, not included in income, which is huge. Only thing though with a Roth is that it's not easy to get money into a Roth because contribution limits are pretty low. They're subject to phase outs, like those deductions we talked about. And if we're looking to convert, we can do a conversion from a traditional to a Roth, but that's a taxable liability in that year. So Roth conversion, tax liability. So if we're thinking about establishing a Roth IRA and maybe funding it through a conversion, here's a couple things that we can consider. And that's really what I include on the slide here, like this first bullet here. Where do we think tax rates are going to be in the future? If we think tax rates are going to be higher tomorrow, well, then it makes sense to pay taxes today and convert today. But something we have to keep in mind, though, is that there's no do-overs. So if you convert your traditional to a Roth, you can't go back and change your mind. Something that used to be available, not available anymore. And we can't forget about Medicare. So I mentioned that Roth income can lower those Medicare premiums, right? Lower the IRMAs or surcharges, but a conversion really at age 63 or beyond could raise those Medicare Part B premiums, could raise those Medicare Part D premiums, at least for a year. So that's something to be aware of. And then something else we have to be aware of is that if we are looking at a conversion, it's going to increase your taxable income. And that taxable income could potentially phase somebody out of some of those new OBBA deductions, right? The new OBBA deductions we talked about. So they're all phased out based off the income you have coming in. So that's something to be aware of. Something else we need to be aware of, which is more of a positive, is that it's not a all or nothing transaction, meaning you could do partial conversions. And what we'll quite often see is individuals wanting to take advantage of a Roth IRA. And what they'll do is a partial conversion up to their threshold amount, whether it's a phase out threshold or a tax bracket threshold, they'll just convert up to that amount. So either way, Roth conversion, a lot of information here. Roth is great to have in retirement as far as that tax diversification, but it is 100% a conversation you have to have with one of your advisors, with the advisor you're working with the FAA team, just because they'll know your specific situation and whether or not a Roth conversion makes sense. But when we talk about just Roth conversions and really Roth distributions, there's so many studies out there where it's Vanguard said with tax efficient distribution strategy and retirement, you can save 40% in taxes. Fidelity has suggested that tax efficiency, especially when we come to that distribution phase, can add 110 basis points to a portfolio without any additional risk. So a lot of benefits to tax diversification. It's just getting those assets in those accounts, which may be tricky or maybe more of an in-depth conversation. So conversion, taxable events. Here's a couple ideas though on this slide that really look at ways to potentially reduce what could be that tax liability. So a conversion could be right for somebody with excess deductions, right? That first bullet point, or Lindsay had mentioned business owners. If you're a business owner where net operating losses could be utilized to offset what could be a tax liability, that's a great opportunity. Maybe somebody's still participating in their retirement plan, and that retirement plan allows for after-tax contributions as well as in-service rollovers. And what that's called, I'm sure you've heard on different websites, different outlets, but that's called the mega backdoor conversion. It's utilizing your 401k to put money, after-tax money, into a Roth. And really, depending on your situation, maybe a normal backdoor Roth conversion could be something that you could take advantage of. Plus, if we're looking at all those deductions that were just introduced with OBBA, maybe one of these new deductions could offset that conversion tax liability. Like, again, those age 65 and older, additional deductions that they do have, as long as they aren't phased out by income and they aren't going to impact Medicare premiums going forward. So definitely a lot of information, but again, it's just a great conversation to have with your advisor because they'll know the specifics of your situation and they'll be able to determine whether or not a conversion or a contribution or maybe a backdoor conversion, if any of those make sense for your situation. So finally, area we'll look at is really those wealth transfer strategies. Quick recap: if you transfer assets to someone while you're still alive, that's a gift. And I know Lindsay mentioned this earlier, but for this year, you can gift up to $19,000 per person, and that's per person per recipient. And that $19,000 it's the exclusion for the year, meaning you don't have to file a gift tax return if you do that. And that's $19,000 individual, $38,000 for married couples. So they can gift the person up to $38,000 without having to file any type of gift tax return. But if they did happen to gift more, then they would have to file a gift tax return but it most likely would not be a gift tax liability. Instead, what it would do is lower that lifetime exclusion we talked about earlier, right? That 15 million per individual, or 30 million for a married couple. So a lot of opportunities for gifts out there, for individuals, whether they're looking to maybe gift a 529 or a fund of 529, or just gift outright. And when we talk about gifting outright, usually these type of strategies have an end goal, and that's to lower the value of an estate. And the reason why individuals would want to lower the value of their estate is to potentially reduce an estate tax liability. And individuals, what they could do is utilize that gift tax exclusion, like we just said, making those gifts every year to their loved ones, to their heirs, to charities. This is going to remove those assets from your estate while you're alive, and basically lower maybe the potential of an estate tax liability down the road. Or you could gift assets to an irrevocable trust, right? We'll see a lot of irrevocable trusts used to lower estates values, but also capture the growth of any of those investments in the trust, keeping the growth out of somebody's estate. Or we could gift to charities. We could utilize donor advised funds. We can look at charitable remainder trusts. Or we could just, again, make gifts outright to charities as we want, or even leave charities as beneficiaries to pass on later. So with that being said, looks like we're getting close to time here. That was just a quick overview of the OBBA and a couple of planning ideas, but it's really, I would say it was the provisions that would impact individual filers more than some of those other provisions that were included in the Act. And, as I mentioned, that this Act, it made these sweeping tax changes really with the intent to spur business growth, really to preserve a lot of those tax reductions that we had previously. And really, it's only time that will tell as far as how effective this may or may not be. But it's really this type of presentation that I think is just a great reminder. And it's a great reminder of some of the top concerns or top really ideas that individuals have as they really transition into that retirement, whether it's pre-retirement or they are in retirement. It's, if we're talking about taxes or income strategies or expenses, it's these financial challenges that continue to be really a top concern for most individuals out there. And that's where a strategy that includes something like tax diversification can really create that flexibility and really help individuals to, maybe adapt to whatever the uncertain future tax landscape might look like. So simple idea, but really the less we pay in taxes, the longer the portfolio is going to last. Because every dollar that's spent on taxes is just one less dollar we can spend on ourselves, right? So with that, I appreciate everybody's time. What I'm going to do is turn it back over to Lindsay, and then we will open it up for questions.
Thanks so much, Mike. I'm actually going to jump in here and I wanted to thank you so much for the presentation. Lindsay, thank you for your time as well. And to everyone who joined, we really appreciate you taking the time to listen in. I think we answered all the questions in the chat. So if you have another question, please reach out to the person that invited you, and they will be, sure to get you an answer. We'll be sure to include everybody for the next time, for our next presentation, our next educational seminar. And without further ado, want to thank again, Mike, Chris, and everybody at Transamerica, and everybody else at Financial Advantage Associates for helping us. And have a great night, everybody.
All right. Thank you.
Thanks again, Mike. Thanks, Perry.
Very welcome.